You're listening to the Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from the Moose on the Loose. How are you doing this Wednesday? I hope you're doing well. Today, we're going to talk about companies that have a robust business model to go through this volatile market. So just want to make clear, yes, we're talking about safe stocks, but the definition of safe stocks could be quite different from one person to another, especially when you think about safe stocks. I mean, there are no place to hide if the entire market goes down by 15-20% in a year. Like almost all companies are not going to have a good year. So by safe stock, I don't mean that the stock price will not fluctuate and will not be in down territories, but mostly focusing on the business model side, where you can tell that the company is still going to continue to do well regardless of what's going on with tariffs and with a recession and with anything else. So of course you're not going to pick a company that is manufacturing most of their goods in Canada and selling most of them in the US. That would be like super highly exposed to tariffs, but probably companies that are not necessarily related to what's going on in the US, or have like a business model that the barrier to entry and the economic mode is so strong that there's not much people can do anyway to destroy this business at this point. The first one on this list is actually Waste Connection, WCN. I recently added to my portfolio, and that was kind of interesting because I explain why I added it. I saw that as a play against, like, a play into a recession-resistant business, a defensive play against what's coming up in the market. And a lot of investors were right to tell me, but Mike, you're buying a stock trading near a all-time high. The valuation of the WCN, I mean, I'm not gonna lie, it's a bit disgusting. We're talking about, like, most of the time it trades around like 50 times its earnings, which is kind of crazy, and yes, not really convincing from a value point of view. So forward PE right now is at 36, but the current PE ratio is at like 80 times the earnings right now. So you're just thinking, well, dude, you're not making like the right move. But again, it's a defensive play, and defensive companies are gonna do well when the market goes crazy and everybody is concerned about what's going to come up next. Well, Waste Connection keeps on going to take care of like waste collection, disposal, and doing some recycling on the side as well. So that's not going to change. They have long-term contract with a lot of municipalities. They have like corporate contract as well. They keep on growing by acquisition. So, and they have like one of the most important asset here and higher barrier to entry is to have like land to like a large network of landfills. So it's hard to have more lands for like this, and it's quite costly. There's a lot of regulation around that, and that pretty much saves the business from getting into a lot of competition elsewhere. Plus, having long-term contract also like kind of like bulletproof the business model. Even if we go into recession, I mean, we're still gonna have waste. We still have to take care of it, and there you go. That's why it was one of my pick this year when I made a few tweaks to my portfolio. Another place to look at, and unfortunately, when we're talking about safe stocks in a volatile market, those companies it's better to hold them before it happens. The problem is, before it happens, they're not exciting because they don't generate necessarily a lot of growth. But on the other side, once the market goes sideways, well, everybody is rushing into those, and therefore you're a bit late for the party. So more like take some good notes right now, and make sure you have maybe some in your portfolio going down the road when you're thinking in decades. Like, right, the current consideration doesn't matter much anyway. So consumer staples, it's an obvious one. In Canada, though, pretty hard to find a lot of great consumer staples besides grocery stores. Grocery stores are great in Canada. We have Empire that is running Sobeys and IGA. We have Loblaws or George Weston, depending on which name you want to buy. They have like very similar business because George Weston own most of Loblaws. So it's like one or the other, but in the end, it's pretty much like the grocery stores. And then you have Metro that is mostly based in Quebec and a little bit in Ontario. I like all of those. Like those three shows like great perspective, very stable. I have the same concern about them too. The problem is there is a lot of competition among themselves, but also considering that you have like Costco, Walmart, Amazon, a lot of like big guys in the US coming in Canada trying to sell food as well. Margins are not going to expand that much, I think, going forward. But in the end, everybody has to eat. So it's a great place to find some comfort in those crazy markets, especially because you can always think, well, you know what, no matter what happens, like the number one budget item will be groceries anyway, so it's a good place to hide. Another one I want to quickly highlight because I just talked about it is Dollarama. Depending on where you get your information, it's either going to be classified as consumer discretionary or consumer staples. I think it's a little bit better to see it as a consumer staples, but for example, at DSR, we use White Chart and Refinitiv, and it's classified on their consumer discretionary. So go figure. But anyways, this one definitely recession resistant as well. So an interesting one. Another one that could fall into that category that is also classified as consumer staples is Alimentation Couche-Tard, ATD. You know my love for Couche-Tard. I don't have to talk about it too much. The stock is not doing that great over the past year and a half, but the business model is robust, and I don't see this company going anywhere. Speaking of companies that have like a robust business model, but the stock price is not doing great, railroads. Canadian Pacific, Canadian National Railway. Pick one. Depending on what you're looking for, you want to benefit from the Kansas City Southern acquisition and the exposure to a road towards Mexico. You go with Canadian Pacific. You want to go focus on a dividend grower. You go for CNR, Canadian National Railway. Both of them are beaten up right now, but I mean, let's be honest, like no other business will replace railroads, and no other railroad business are going to emerge in Canada anytime soon. So this is the type of a great company to have in volatile market, because even though their stock price will fluctuate because we expect lower volume, lower demand for transportation. So of course, they're not going to have a great year, but for the long run, it's usually the best time to add some to your portfolio. And I mean, I would just feel good about having some railroads. I mean, full disclosure, I have Canadian National Railway in one of my portfolio, so I do have like a position in this field. Another place that you can go, which is actually doing not too bad right now, utilities. Utilities, because yes, they are influenced by the overall economy, but there is a very large business base that is not going to go anywhere. My favorites right now, Fortis, Hydro One, definitely. I mean, Fortis is a classic, has been like classic like foundation stock in my mind, with those like 50 plus years of dividend increase, the ability to keep on clockwork 4 to 5% dividend increase every year. Amazing business. And then you have Hydro One that is doing great these days. May seems expensive, but as I like to say, there is a price to pay for quality, my friend. And that's part of it too. Yesterday I discussed stocks going up double digit in the gold sector. So this is definitely a great place to be when the market is volatile. Gold is always the place. I don't like the fact that it also goes down very quickly, so that's why I ignore it. But still, it's an interesting place. Going into the financial sector to wrap up this episode, TMX. I discussed this one on Monday on stocks that I wish I had invested in. This one, regardless if the market goes up or goes down, as long as there are trades, they're gonna make money. And I mean, right now with the volatility that we have a lot of volume, and a lot of volume means a lot of money for a company running a stock exchange, because they're making information, like they're making losing money on all those trades that are being made on their exchange. And on top of that, they can charge for all that information and research they produce, data and analytics to their clients. So definitely a great place to be. Finally, life insurance companies seems to not doing that bad these days. Again, the big guys, you have like Sun Life, Man Life, Great West Life. Of course, their portion of their business that is related to wealth management, that is usually between 20 to 30%, depending on the company, will be affected. But the life insurance business a little bit less, so it's more invested for the long run, and that could be also interesting to add to your portfolio. On my side, I have a very small position in my Smith Maneuver into Great West, but I don't have that much there. I'm not really involved in life insurance company. I prefer banks. Well, I mean, and it's all about like what you prefer, right, or not. So all right, Moose, that's enough for today. Tomorrow we're going to talk about opportunities. So I've looked at my stock screener and look at companies that have dropped double digits since the beginning of the year. So we're going to the opposite side. We discussed double digit grower at the beginning on Tuesday, and tomorrow on Thursday we're going to talk about those stocks that I like, but they lost a lot of money on the market these days. So all right, guys, that's enough for today. Stay tuned until tomorrow morning, and don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.